Okay, in our last session, we looked at the statement of owner's equity. In this session, we're going to look at the balance sheet. Now, there is a fourth statement, the statement of cash flow, but we're going to do that at a later time. So the balance sheet will show us assets, liabilities, and owner's equity. And it is a reflection of the accounting equation. Now, you'll notice that the balance sheet does not have month ended or year ended. It's a snapshot on a particular day. However, it is often done with the other statements. And the idea behind this is to show that our accounting equation balances and to allow investors and lenders and others to get another picture of the financial condition of our business. You'll see that there are two ratios we can do. There are many, but we can do these two as well. So when we're doing the balance sheet, we can take down our assets. So we can go from cash down to accumulated depreciation equipment. Those are our assets, so we can copy those down. This type of balance sheet is called the account form, where we have our assets on the left and liabilities and equity on the right. There is also a report form balance sheet, which shows them in a vertical sense instead of horizontal. So our cash balance now is going to be $7,600. So we're going to bring down our balances. Accounts receivable is $19,300. Prepaid rent is $400. $5,600. Equipment is $19,600. And accumulated depreciation, remember, has a credit balance. It's an offset to the asset account. So that has to be displayed as a negative. So that's going to be negative $4,400. Remember, there are no debits and credits on balance sheets or income statements or statements of owner's equity or any financial statement. Okay? So there are no debits and credits on financial statements. We just use the columns and we do our calculations based on that. So there are no debits and credits on financial statements. So let's get our liabilities now. And that would be the accounts payable, salary payable, and unearned service revenue. So we bring our liabilities down. And our liabilities include accounts payable of $4,200. Our salary payable of $1,000. And our unearned service revenue of $1,300. Now we can total our liabilities. Okay. Again, we should do our thick bottom border here, indicating that we're adding. So our total liabilities come out to $6,500. Okay. Now our owner's equity is going to consist of the Dyna Capital account. Remember, we're not going to take the capital from here. We're going to take the new capital that we calculated on our statement of owner's equity. Okay, so this new capital of $36,800 is the capital that will carry over into the next period. Okay. So now we can do our liabilities. We have to abbreviate here. And owner's equity. Okay. And on this side, we're going to do our total assets, and they should balance. Remember, assets equals liabilities plus owner's equity. So our balance sheet gives us a summary of our asset, liability, and capital account, and it also verifies the accounting equation. So let's add up our total assets. So again, we should do our thick bottom border, to indicate we're adding. So we got 43,300. Our liabilities plus our capital should equal that. So again, we should do our thick bottom border, and we're going to take our total liabilities plus our capital, and it should equal the 43.3. And it does. So we're in balance. So we can be confident in our numbers, okay, that we're in balance. The accounting equation balances. We have a summary of our asset, liability, and capital accounts. Okay, so now we can do a bottom double border. This indicates that we're done. We did it on the other statements as well. This indicates that we're done and we're confident in our numbers. Okay, so that's the balance sheet. Now, as there is with the other statements, there's ratios we can do to help us determine the financial condition of the company. One of them is the debt ratio. Okay, now the debt ratio looks at total liabilities divided by total assets. And the purpose of this is to determine how much of our assets are financed with debt. We can see, just looking at the numbers, it's a very small amount here. Okay, but it gives people looking at the balance sheet a good idea of how well we're managing our debt. Okay, what percentage of our assets is financed with debt? So if we take our total liabilities divided by our total assets, we get 15%. Not bad at all, very low. The average for American companies is around 50%. So if we look at this company so far, we can see that they had a profit margin ratio of 43%, which we calculated in an earlier video. And we see that they have a debt ratio of 15%, which is very low. So, so far, the company looks pretty good. Now, the current ratio looks at current assets and current liabilities. If you remember from adjustments, current assets are those assets that are going to be used up or turned over within a year. So if I look at my assets, I can see that these are my current assets, okay? Any account that has an accumulated depreciation account attached to it is not going to be a current asset. Why? Because it's going to last over several periods, okay? So these are our current assets. Now, all of these liabilities are current, okay? You know, often there's long-term liabilities. There's none in this example, okay? But current liabilities are going to be those that are going to be, we expect to pay off within a year. So all of these liabilities are current. So if I want to calculate my current assets over my current liabilities, there's several ways I can do it. Okay? I just total these up. Those are my current assets. My current liabilities are going to be the same as the total, okay? Which is not always the case. This happens to be the case here. Okay, so to get my current ratio, I'm going to take my my current assets over my current liabilities. So my current ratio is going to be 4.32. So what does that mean? Okay. What that means is that I can pay my current liabilities with my current assets 4 times over. So I can pay my current liabilities with my current assets 4 times over. So I don't have to dip into my long-term assets. I don't have to sell some of my equipment to pay my current liabilities. So this is an outstanding current ratio. The norm is about 1.5. So these are two of the balance sheet ratios that you'll need to know. So again, thank you for your attention.